Welcome to Wahsa Distance Education Center's radio Zoom classes. This is MEL3E, grade 11 workplace math, and I am the teacher, Bronwyn Slade. If you'd like to participate live today, you can call the Wahsa studio at 1-800-465-7144 or 737-4017. You can listen on the radio at 91.9 FM or on the television at Bell Express View channel 972. You're always welcome to join me live through the Zoom link that is available from your teacher and also from your DEC. Our classes are scheduled Monday through Thursday from 9 till 10 in the morning, and we are now starting our 6th week of our 9-week course. At this point, you definitely should be submitting work for marking to make sure you're on the right track and you're hoping to complete this credit this year. So the support questions, the ones marked with the pencil icons, are not for marking. So you just decide which ones to do and how many to do, depending on your needs. If you are understanding a concept, feel free to skip questions. You don't have to do them all just because they are there. But if you need more practice, that is totally okay as well. So just ask me and I will send you more practice. The key questions are the ones with the little key icon, and they are the ones to submit for marking. So please do all of these questions, showing all of your work, your steps, your thinking. This way I can give you credit for all of your understanding. And if you are making errors, it gives me information to help you figure out why you're making errors and if I can help you improve and learn. More information is better. There are 3 different methods for submitting your work. The first method is to scan your work and send it in electronically. You can scan your completed work through a smartphone or device. If you have an iPhone, you can use the Notes app. If you have an Android device, you can use the Google Drive app. Both have scan functions and they're fairly straightforward. This makes your file a little bit smaller and a little bit easier to send. If that doesn't work for you, it's totally okay to take a picture and send that to me as well. Many students do that. So either way is fine. Whatever works best for you is really fine. Then you can send it to me either through email to studentwork@nnec.on.ca and CC it to bronwyn.slate@nnec.on.ca. Or you can also send it to me through Facebook Messenger at bslatewahsa. The second method is to drop off your work in Sioux Lookout. So we have an outdoor mailbox at our building at 74 Front Street. We're the bright red building next to the post office, and we have a small white mailbox next to our side entrance. And then the third method is to hand your work into your DEC. Then your DEC can either send your work through the Express or fax it to 807-737-1732 or a toll-free fax to 1-800-463-7852. If you'd like to connect with me through social media, both my Facebook and my YouTube channel have the name bslatewahsa. So if you want to friend me on Facebook or subscribe to my YouTube channel, then you'll get notifications whenever I upload one of our lessons. All of our lessons are recorded and I upload them to YouTube shortly after airing. So that's an easy way to access them and be able to review them when it works for you. There also are short videos explaining common errors and confusing concepts on my YouTube channel. Some of them apply to our course, some of them may not be relevant, but it's a good place to access if you're confused about something, to check out there first to see if I've addressed it before just doing a random internet search. If there's anything that you'd like me to add, I'm happy to do examples and add more videos as we go along. Math is an incredibly visual subject. So I strongly encourage you to access the videos. This is going to set you up for the most success. Listening is great, but seeing the whole picture and hearing what I'm saying is going to really make the most sense. So either joining me live through Zoom, even if you don't want to participate, but just being present so you can see works, or watching the replays on YouTube. If you can't do either because you don't have reliable access to internet, that is completely understandable. Just let me know and I can send you a copy of the recordings and then you can still access them and set yourself up for success. So if you have any questions or concerns, want to chat with me about anything, please reach out. My email address is bronwyn.slate, which is spelled bronwyn.slate@nnec.on.ca. Facebook is bslatewahsa. The phone number at the office is 807-737-1488. extension 2209. You can also call toll free at 1-800-667-3703. My office hours are Monday through Friday, 9 a.m. to 4 p.m. So that is the easiest time to get me directly, though I do teach the first hour and the last hour of the day. So those times I'm not available. All right, today's lesson is another bonus lesson. So we talked a lot about loans and about borrowing money, but your booklet, your IEL booklet, doesn't talk about investing money and how you can earn money. And that I think is a little bit of a gap. So we have a bit of time, so I thought we would throw in this extra bonus lesson to understand investments. They can be really confusing. I don't understand them all. I don't get it completely, but I have a general understanding. So I thought I would share my general understanding today and go through it a little bit to help you have that information so that if you would like to invest, you have some information and that can set you up, hopefully, to get you started. So our learning goals are that at the end of this lesson, you will understand the various types of investments. You'll understand what types of investments might be best for you, and you will understand how to make the most out of investments. You know you've met the learning goals because you know the difference between bonds, stocks and shares, mutual funds, GICs, as well as RRSPs, TFSAs, and RRIFs. You can explain risk tolerance and have an idea what type of investments are right for you. You can explain why time and regular payments increase the value over the overall value of a investment in the long run. Okay, but first let's activate our brain. Monday morning, we might be a little bit foggy and do some mental math. Hopefully by this time you know that I am not a believer in mad minutes and why I think that they're problematic. Really, they don't set students up for success and they don't generally give people tools that they can use in their daily lives. So instead, we work on developing tools and strategies that we can use in various situations depending on what our needs are and what our skills are. So our question today is 74 takeaway 36. And we're going to be using the strategy of adding up. So many people use this, particularly when they're dealing with money. I'm going to draw down a number line. You don't have to use a number line. You don't have to write anything, but this is just sort of how I visualize it. So if I'm adding up, what I'm trying to figure out is if I start at 36 and I want to get to 74, what steps do I need to get there? So from 36, I'm going to add 4 to get to my next whole tens. So that's 40. And then from 40, I'm going to add as many tens as I can to get to 70. And I can do that in one jump. That's 30. Or I can say, if I don't know that, I can go 10. So 40, 50, 60, 70. So that's plus 10, plus 10, plus 10. And then to get from 70 to 74, I need to go up another 4. So in total, I jumped up 10, 20, 30, 34, 38. And that's how adding up can be really helpful. And that's why many folks do it. If you pay with $74 and you only needed to pay $36, then you can add up by giving $4 and then a 10 and then a 10 and then a 10, and then another 4 would get you up to 74. Obviously, this in terms of money, you would probably never do that, but it's just the general idea and the fact that you can do it with any number, no matter what. Okay, there you go. All right, so what is our minds on? What do we need to remember? So I just wanted to briefly cover what savings is versus investing, because we've talked a little bit about saving, it's come up, but how is that different than investing? So savings is basically any income that is not spent. So any money that you have, it's saving in your sock drawer, in your bank, wherever. Any money that you aren't currently spending, you could technically count as savings. So generally savings are a short-term thing, like 1 to 3 years. It's ready access to cash. So it's generally really easy to, your savings, you can, if you need it, you can get it. There's minimal risk. You're not going to lose your savings if you have it just in a savings account. Your number's not going to go down. It has low earning potential, so you might have a very small interest rate, and you might earn a couple of cents a month or something, but you're really not earning very much. And it does not generate enough to beat inflation. So inflation is how much our money becomes worth in the future. And so things constantly are getting more and more expensive. And so then everything gets more and more expensive, and then people get paid more, but really the money is not really that different. It's why, like, when 50 years ago, 100 years ago, $1,000 was worth a lot more than what it is now because of inflation. So things have inflated, have gotten bigger. So a savings account isn't going to help you with that inflation. It's not going to make your money, you're not going to have enough money that's going to, you're not going to earn enough money that means that you don't have to worry about inflation. Inflation is still probably going to have an impact in the long run. Investments are when your savings generate income. So there's still that block of money that you're not spending, but now it's getting money. It's earning money for you. So this is a long-term thing. It's generally has to be over 3 years at least in order to make any difference. It is longer to access. You can't just go into your investments and get your money immediately. There's generally hoops and processes to go through. It always involves risk. So there's always the potential that you could lose your money. Sometimes more risk than other times, and we're going to talk about that later. It has a higher earning potential. So this is how, if you want your savings to make money, investing it means that you're going to get more than those just couple of cents a month. And there are lots of options, which can be confusing, but generally all of your options are going to beat inflation. So they're all going to help you in terms of making sure your money is worth something relevant, something useful in the years to come. Okay, so that's just the difference between savings and investing, so that we know as we go along what we are talking about. So when we'll use this in real life? Well, beyond just being able to choose to invest if you want to, we are building brain muscle in our class. So practicing, talking about these concepts, engaging in things that are hard, and repeating that practice over and over again is how we build new pathways in our brain. And so stretching our brain out of our comfort zone, trying to deal with something that is challenging, is how we build brain muscle. Now, our brain isn't a muscle, so this is why it's in quotations. It's not actually, you're not actually building brain muscle, but you are making new pathways and strengthening your brain. And can't think of what I wanted to say, sorry. So it's the same idea in terms of that you practice if you want to build physical muscle. So if you want to build your leg muscles or your arm muscles or something, then you practice a movement repetitively. That movement might not be what you need to do in the long run. So lifting weights, lifting barbells over and over again probably doesn't have direct application in your real life. Most of us are not running into barbells that we need to pick up. That's not true. Do we all need to pick up stuff? Yes, constantly, whether you are a parent or you are a construction worker or you are even working in an office building and need to move around boxes. Things constantly we are having to pick up. So lifting a barbell might not be helpful, but it's developing the skills, it's building the muscle so that you can use the skills that you want to in your life. The same way with math and same with everything in this course. We're building brain muscle so that we can use these strategies in places that do apply in our lives. All right, so what are these investment options? What are the most common ones? So first, you may have heard these words and we're going to try to understand a little bit more what they mean. I constantly get them mixed up. It is what it is, but trying to engage with them a little bit more means that we're building those new pathways, we're remembering a bit more in our heads. So bonds are simply a loan taken out by a company. It's an IOU between a lender and a borrower. So a bond is very similar to if you think like a personal loan that we've been talking about, but it's for companies. So instead of going to a bank, the company gets this money from investors who buy its bonds. In exchange for capital, the company pays an interest coupon, which is the annual interest rate paid on a bond expressed as a percentage of the face value. So that sounds a little confusing, but the idea is that the company is asking people to invest in their business, and then they're saying, IOU, they give you, your bond is an IOU that says, I'm going to pay you this much interest on whatever our profits are over the course of the year. So the company pays interest at predetermined intervals, usually annually or semi-annually, so once or twice a year, and returns the principal on the maturity date and into the loan. So the company is paying back interest over while you have the bond, and then by the end of it, it pays back everything that was borrowed when the end of the loan is. So that's a bond. Shares and stocks. So a stock, also can be known as equity, is a security that represents the ownership of a fraction of a corporation. So having a stock, it means that you own a small part or a large part, depending on how much you buy, a part of the business, a part of the corporation. So this entitles the owner of the stock to proportion of the corporation's assets and profits equal to how much the stock they own. So if you own 50%, if you have a stock that is 50% ownership, then you are entitled to 50% of the profits and 50% of the assets. If you own 2%, a stock that is 2%, then you means that you are entitled to 2% of the profits and 2% of the assets. And that's how stocks and shit work. The units of a stock are called shares. So your shares are that 50% share or your 2% share. So corporations issue or they sell stock to raise funds to operate their businesses. The holder of a stock, a shareholder, buys a piece of the corporation, and depending on the type of shares held, may have claim to part of its assets and earnings. So we're not going to dive in deeply in terms of how to buy stocks or how to understand the stock market. I don't understand that. You should go to a financial advisor if you're interested in that. This is just an overview of how it works, because not everything is going to be the same. Not everything's going to have the same sort of payout. And that's beyond what we need to understand for this. But just having a general idea is important of how bonds and then stocks are different. All right, so then we have mutual funds. So a mutual fund is a type of financial vehicle made up of a pool of money collected by many investors to invest in securities like stocks, bonds, money market instruments, and other assets. So basically a mutual fund is a pool of money. That's what stands out to me the most, is that instead of doing it by yourself, you are pooling your money with people. You don't have to know the people. You go through a financial institution. So it's not like it's your office staff or your group of buddies. It's fine to not know them, but you're pooling your money with a group of people and then you invest. So now means that you have more money. And we know that if you invest more money, you're going to have a higher interest return overall. So the bigger chunk of money being invested in the stocks and the bonds that we just talked about, then that means that you get a higher interest rate, you get a higher income back. And that's why mutual funds make sense. Mutual funds are operated by professional money managers who allocate the fund's assets and attempt to produce capital gains or income for the fund's investors. So this is, again, why you don't have to understand it all. You just give your money to somebody who is a professional and say, all right, I'm investing in a mutual fund. This is the type of businesses I'm interested in. Personally, I've opened up an RESP for my kiddo in terms of a registered education plan. And so that's a type ends up investing in a mutual fund. And I said that I wanted it to be ethical. So I wanted to make sure that I was investing in ethical companies, and there were not a lot of options. But there were. And so that wasn't the first option that I was given. I was given something that was like, they thought that was the best option for me. And I said, okay, but this has companies that I don't want to support. And so I told my money manager, the banker that I was talking to, that I didn't want to support those companies. And so that I wanted to have I wanted to have a mutual fund that we only supported ethical businesses. We only invested in ethical businesses. And so they found me portfolio is what they call it, but a collection of investments that were ethical, have been deemed as ethical investments. And that's where I put my money to invest in order to grow an education fund for my kiddo. So that's just how that sort of works. You get to have some say, but you don't have to have all the understanding. Unlike stock, mutual fund shares do not give its holders any voting rights. So though we are investing, though maybe we are buying stocks as part of the mutual fund, we're not owning part of the corporation. We're not shareholders in the same way. That means that we get to vote and be part of the decision-making of those companies. Right, and the last one is the GIC, which is a guaranteed investment certificate. So a GIC is a safe and secure investment with very little risk. You don't have to worry about losing your money because it's guaranteed. So it's like a savings account that you deposit money into and earn interest on that money. The difference is that you need to leave your money in a GIC for a specific period of time. So a savings account, you can put money in and take money out every day if you wanted to. A GIC, you commit to a term, 3 or 5 years, something like that. And you say, okay, I'm going to leave this money here. And that means that they can invest that money for a period of time and they know it's going to be there. And they guarantee to give you your money back, and then as well as the interest. So terms last anywhere from a couple of months up to 5 years. And if you take it out early, you pay a penalty. So the longer the term, the more interest you pay. So that's how these work. So that the fact that you pay a penalty if you take it out means that you can, it's your money, but you're going to be charged a fee, a penalty. So if you choose to do that, so that helps dissuade people from doing it. Okay, so those are the various types of the general types of investments that you may have heard before. Hopefully you can understand them a little bit, how they're different and how they might be beneficial. All right, so now let's talk about taxes and investments, because that can be something that we can hear a lot as well. So these are other types of investments or other things, but they have to do with other plans, but we know that they have something to do with taxes, but we don't necessarily understand how that works. So the first one is registered retirement savings plans. So these are the RRSPs that you may have heard of. So this is an account that helps to save for your retirement. So you put money in when you have an income, and then when you retire, you're not having an income, this money is going to help you survive. So it can be a GIC, a mutual fund, bonds, or shares. They all can be held in an RSP. So it's not the type of investment. This account isn't it isn't about how you're investing. There's other benefits to it. So you can still have a GIC, you can still have bonds, you can, if any of those make sense to you and feel good, you can still have that while having an RRSP. What an RSP is about is that it helps you reduce your taxes while you save. And so they're tax exempt the year you make a contribution. So if in 2022, you open up an RSP and you're putting money into it. So you're putting in $100 every month. So that means that over 12 months, you put in $1,200, $1,200 into your RSP. That $1,200 is not going to be taxed as part of your income. So remember, we talked about income and how those tax pockets work. So you're taking $1,200 out of those pockets and putting it in an RSP, and it means that you don't get taxed on that amount of money when you put it in. So anyone who earns an income and files a tax return can open an RSP at any time. Okay, so what are the pros and cons? So the pros are that contributions and tax and interest are not taxed. So while you're putting money in and while that interest is growing, you're not paying any tax on it. So this reduces your taxable income. So it means that you could go from 2 pockets down to 1 pocket instead of having to pay a higher interest, a higher tax rate on that money that is in that second pocket. If you are putting all of that money in an RSP, that's still your money. You're putting in an RSP, saving it for later, but you're not going to get taxed on it. And that's what it means by reducing your taxable income. You can withdraw your money from your RSP to fund your first down payment if you're buying a house. And your RSPs are protected from creditors. So if you are struggling with debt and people are taking your money because you owe them money, an RSP is protected from that. Okay, so those are the pros. The cons are that your RSP's withdrawals are heavily taxed. So what that means is that once you are ready to take your money out of your RSP, that's when you pay your tax. So you don't pay tax when it goes in, you're paying tax when you're taking it out. Because at this point, you're assuming that you're not making an income anymore. So that's why they're taxing it at that point. However, the tax rates can be high. I don't know them exactly, but that is just how that works. Withdrawals are not added back to your contribution room. You have a certain amount you're allowed to add in or contribute every year. When you take the money out, that doesn't mean you can add in, like if you take $500 out of your RSP, that doesn't mean that that year you can contribute 500 more. That means that you're just taking money out. That doesn't change your limit. Your contribution limit is based on your income. So that means that you, depending on how much you earn, sets how much you can contribute. So that can be challenging if you're trying to save, but they decide that you are only allowed to contribute a certain amount because of what they know about your income. And then you must close up your RSP by age 71. So once you are 71, you can no longer have an RSP. You don't have to take the money out and use it, but you have to transfer it to something else if you are not going to take the money out. It just means that you can't put money back in. So you can't put any more money in. So you can continue how the RSP means that you can access it and you can set up regular payments so that it comes out, but you can't put any more money in. So if you want to keep investing and put more money in once you're 71, you need to do something different. And that's an RSP, general overview. All right, so now let's talk about a tax-free savings account, so TFSA. So a registered tax advantage savings account. So what it means is that the contributions to a TFSA are not deductible on tax incomes. So that means that when you are putting money into a TFSA, you don't get to take that money out of those pockets when you're doing your calculations for taxes, for income tax. So you're still paying tax on it, even though you're saving it. But the interest that you earn is tax-free. So you're not paying taxes on the interest. The limit for 2022 is $6,000. And any resident of Canada who is 18 or over and has a valid social insurance number, who also earns an income and files a tax return, can have a tax-free savings account. So when it says tax-free, what that means is that the interest that you're earning is tax-free, not the contributions that you're making. Again, pros and cons. So the pros are that it's tax-free investment income. So you're not ever going to pay taxes on the interest. Whereas with the RSP, right, when you take the money out, the interest that you earned, you get taxed on it because you're just taking the money all together. They don't distinguish between if it's principal or interest. Pros are that it's easy to withdraw process. It's easy to take your money out, whereas with an RSP, that is a bit more complicated. Your contributions room is not determined by income, so the limit is the same for everybody. And unused contributions room never expires. So that means that if you don't put in, so this year you open up a TFSA and you only put in $1,000, great. That means that next year in 2023, you get a new limit of $6,000. You can put in $6,000, but the $5,000 that you didn't put in this year, you could put in now. So you could put in another $5,000. So you could put in $11,000 in 2023. So that you can roll over. So if life is rough and you're able to open up TFSA and you're able to do it for a period of time, but then you have to stop making contributions, then if you just leave it open, then all of those limits roll over in future years, so that maybe as things change, you might be able to add in more money later on. Cons of a TFSA is that your contributions are not tax deductible. So when you take the money out, you don't go with taxes, but you pay taxes on when you're putting the money in. There's no grace amount for over contributions. You can't put more money in than the limit. In an RSP, you can, it just changes things a little bit, but a tax-free, once you hit that $6,000, you hit that $6,000, you can't put any more money in. It's not protected from creditors. So if you're owing people money and you have a TFSA, they can make claims to it because they can say, hey, you owe us money. You got savings sitting there. You got to pay it to us. And then also the withdrawal process is too easy. So that can mean that you're not just letting your money sit there and save it. So with an RSP, it is harder to get your money back until you are actually retired. With a tax-free savings account, it's easy to be like, oh no, I really need this thing. I'm just going to use my tax-free savings account. So which can be challenging for some folks. Right. And then we have a registered retirement income fund, an RRIF. I had never heard of this before, so this one might be new for you. This is a retirement fund similar to an annuity contract, which pays out income to one or more beneficiaries. So what this means, because that's a lot of words that you may not know, is that you are still investing your money's still investing, it's still earning income, but it's paying out payments to you for a certain period of time. So you're saying instead of you retired, you're not making your income anymore, but you have this RRIF, and so there's money there, and so it's paying out a certain proportion of that amount of money every month, so that you have that as incoming as income. And it can be so that's the annuity contract part, is how it's making payments out to you at a set period of time for a set amount. The beneficiary part, or it can be you, or it can be somebody else that you decide that to if you are no longer living. So it means that your income, your investments don't just disappear. It means that your spouse, if you have a partner or a spouse that you have listed as your beneficiary, they can benefit from this as well. If you have children or people in your life that you are setting as your beneficiary, you can say, okay, once I die, I want this income to go to these people. And then this investment will pay out to them on whatever your set timeline is. So often how this works is that owners of RSPs roll over their balance. So if they want to continue to invest, they want it to continue to grow, but they've turned 71, they can't do an RSP anymore, they're going to shift it from an RSP to an RRIF. Earnings in an RRIF are not taxed, but payouts are considered income for the beneficiary and therefore taxed. So the same idea with an RSP is that it's not taxed going in, the interest is not taxed, but when it comes out, it gets taxed. And then the other thing is that you must take out a taxable minimum amount each year. So when you have a registered retirement income, you have to take out money. Money has to be coming out. There's a minimum amount that has to be paid out every year. So you can't just save forever. It has to come out. So the pros and cons are, so while you have to take out a certain amount each year, there's no maximum amount limit. So you can take it all out if you wanted to, or you can take out half or whatever you decided to, what you want that maximum amount to be, or what that payment to be. You get to decide that as long as it's over the minimum amount that they set. So if your spouse is younger, this reduces your mandatory withdrawal amount. So I don't understand that completely, but it changes your minimum if you have a spouse who's on your fund. and then that reduces the amount that you have to take out. You can leave it to your spouse tax-free, and you grow your savings tax deferred. So your savings are grown, but again, that just, you're pushing the tax off until later. The cons are that yearly payments must be withdrawn. So that means that your investments are depleted every year. So you're not earning as much because you are taking money out. The government and your age dictate minimum payment amount. So you don't get to decide. You have to take out a certain amount, and they get to decide. So you can't be like, oh, I'm only going to take $2, and that doesn't really change my effect of my investment. No, they set what that has to be. And you're greater than your minimum amount, it's subject to a withholding tax. So if you take out more money than the minimum amount, that has a withholding tax that is applied to it. So again, these can be confusing. I still totally don't understand it all, but it gives you a little bit of an overview of how these types of funds and programs work if you're choosing to invest. So now we know the different types of investments. We know some different plans that are tax-free to help improve our investments. Now let's talk about risk tolerance. So risk tolerance is how much your financial fluctuation you can stand over time. So your ability and your willingness to stomach a decline in value of your investments. If you invest, there's no guarantee that your money is only going to grow. You could lose money. Many folks do. You don't get to control that. So depending on if you're able to deal with that, or if that causes you too much stress, that changes your risk tolerance. So there are various key factors: your financial situation, the type of investor that you are, your time horizon, so how long you're able to invest, and the purpose of your investment, what your goal is. That is all going to change your risk tolerance. So if you are an aggressive, if you have aggressive risk tolerance, that means that probably you're market savvy. So you probably understand the market, you understand investing fairly well, you're fairly comfortable with that. I am not aggressive. I don't understand it as well as I would like, or as well as would make me comfortable to be able to have high risk tolerance. So people who are aggressive reach for the maximum returns. They want to make the most money as possible, but they also have the most risk because they are investing in things that could grow a lot, but also they could lose a lot. Then we have moderate. So you're able to accept some risk. This is sort of a balanced approach. Generally, you're investing for 5 to 10 years. So it's long enough that you can deal with some ups and downs, but not necessarily super long. This is probably where I fall in, I would think. Then you have conservative, where you want little to no volatility. You're unwilling to risk your principal. So you really don't want, losing money is going to stress you out way too much. So you want to earn a little bit because you want your money to earn income, but you really are not okay with losing any money at all, which is reasonable. Totally. All of these, there's not a good one or a bad one. Different people are different. Different things work for different people, and that is totally okay. There's not a better one or a worse. So the options for investing your savings are continually increasing, but every one of them can still be categorized according to 3 fundamental characteristics: safety, income, and growth. Let's understand those. So safety is investing in government-issued securities in stable economic systems. So these could be generally bonds, I think, that you're investing in your government or in the government of stable economic countries. They also can be AAA rated corporation bonds issued by large stable companies. So if you're investing in something that is really well established, really knows what they're doing, they are making probably a lot of money, that is a safe investment. Investing in somebody who already knows what they're doing, but it's not a very risky investment. So that means that you are not going to earn a lot. it's kind of like gambling in terms of if you are taking the bigger risk, you're going to get the bigger gains. Your odds are better if you're taking a bigger risk, but you're more likely to lose. Safety, you're not likely to lose, but you're also not likely to win a lot or gain a lot. All right, then we have income. So you're looking for assets that guarantee a steady income supplement, and to get there, you may accept a bit more risk. So income level is that income investors may buy preferred stock shares or common stocks. Again, not something that you have to know. I'm not going to be tested on this. This is just general information to help you understand better. So you want to earn money. And so you're willing to maybe lose money over a period of time. You have a longer set of time to invest for. And so you can deal with a little bit of ups and downs because you do want to have some steady growth. And just that growth might go up and down a little bit. And then growth, the third category, is achieved only by selling an asset. And so it has a degree of risk. And so many individual investors avoid stock picking and go with one or more exchange traded funds or mutual funds. So again, this doesn't really necessarily make a lot of sense to me and you. That's okay. But growth is where you want to earn a lot. And so you're willing to risk a lot. But you're probably not doing that on your own. You're not picking a bit here and a bit there and a bit there. You're going to work with a mutual fund or something like that. So here's a graph that shows the riskier investment, the greater the potential to earn more and to lose more. So here we can see that we have a lower reward. So we have reward along our bottom axis and risk along our vertical axis, lower to higher in both of them. So government bonds, as we said, are a low risk and a low reward. Bank and term deposits are a little bit higher than government bonds, but there's still a lower risk and a low reward. Then as we go up we have some ones in the middle. Again, senior bonds are subordinate bonds. We don't really know what these are. We don't need to understand these. This is not important to us, but it's just a general idea that as we increase our risk into property trusts or equities, then we're also increasing our reward. And that's how investments work. So what type of investor are you, do you think? So I have this questionnaire that I found, and you can go through it if you'd like to see what kind of investor might make sense for you. I will just sort of run through it a little bit quickly, just to sort of see where I would fit. You follow your gut. There's no right and wrong answer. You just follow. The point is to figure out what makes sense for you. So the first one is about time horizon, and I will link this in our show notes so that you can access the original survey and be able to do it yourself if you want. So question one is, when do you expect to begin withdrawing money from your account? And then you can choose from less than 1 year all the way up to 7 or more years. So I'm going to sort of think about this in terms of when I was making a decision for investing for my kids' education. So I said 11 years or more is what I was planning, when I planned to withdraw the money. Once you begin withdrawing money, how long do you expect the withdrawals to last? So I would say 3 to 7 years in terms of if I'm working towards that for education, that makes sense. So add your points up to see what your time horizon makes sense. So for me, 11 plus 4 is 15. So my time horizon is 15. So then now I answer questions about my risk tolerance. So inflation, so number 3, inflation can make your purchases more expensive in the future. If inflation is high today, you will have to pay more for the same items tomorrow. Which of the following counts is most consistent with your investment comfort? So A, account 1 will most likely beat it long-term inflation by a significant amount and has high risk. Account 2 will most likely beat long-term inflation by a moderate amount and has high to moderate risk. Account 3 will most likely beat inflation by a small amount and has moderate risk. And account 4 will most likely match long-term inflation and has low risk. So I say that I like account 3 that will beat inflation by a small amount and has moderate risk. Number 4, the following statement describe the most likely profit as well as the chance of loss of $10,000 invested for 1 year in 4 hypothetical accounts. Please select a statement that in which you are most comfortable. So A, most likely value of the account at the end of the year is 10,600. However, there's 16% chance of losing your money. And then they increase by 100 how much and increase your chances of losing your money. So to me, the highest amount is that you're going to get 10,900. So you're going to earn $900 compared to the lowest amount, which is 10,600. So you earn $300 more, but your risk goes from 16% to 28%. So your risk goes up by 12%. It almost doubles, not quite, but almost doubles. So to me, I feel like that's not really worth it. Those levels, I'm going to say A, that earning a little, but only 6% chance of losing your money. Then you just continue through this. I'm not going to go through every single question just in terms of the sake of time. But oops. So I think when I did this before, I liked that the balance of moderate levels of risk with moderate levels of profit for number 10, for number 5. For number 6, I liked that I would, if it wasn't, if I was losing money and I still had 10 years until I retired, how would I react? I think that I would wait at least a year before changing my investments, something less risky. Then here, in terms of how much profit versus how much loss, I'm going to look at, to me, I look at these in terms of how much the difference is, just how I looked at it. Again, I don't know what I'm doing. And I liked the B, account B feels good to me. And number 8, I'm comfortable with investments that may frequently experience large losses in value if there's potential for higher profits. And I say I disagree. I don't want large losses. So then now we add up our totals. And so I have 6 plus 0 plus 10 is 16 plus 10 is 26 plus, well, 12 plus 8 is 20. So at 26 plus 20 is 46. So then there is a matching your score at the end of this. So my time horizon was, I believe it was 15. 15, and my risk tolerance was 26. So that tells me I can then look at this chart. So my time horizon was 15. So that falls in this top, this one up here. And my risk tolerance was 26. So that falls into here. And so I get a moderate conservative would be their suggestion. So then they tell me what a moderate conservative portfolio is and how that might be a good balance. The last time I did this, when I was preparing this lesson, I fell into the moderate portfolio. So it depends on the day where you might fit. Oh, but it's not 26, it's 46. My bad. That's why I'm like, why is that so different? 46, because I forgot. So that doesn't fall in there. It seemed awfully different. 46 falls into this one here. So that gives me moderate. Mod portfolio right in the middle is kind of where I sit. But that tells you more. So you can look this if you want to. I will link it and you can check it out. Okay, so then a couple of investment tips before we wrap up. So the effect of time overall. So there's an old saying that the best day to start saving for the future was the day you were born. The second best day is today. So it's best to do it for a long period of time, as long as you can. But if you didn't do that, because you probably didn't, then the best day is to start today. It's better to start today than it is tomorrow. So interest is capable of delivering far more growth than contributions once your time horizon stretches beyond 10 years. So after 15 years, the effective interest alone is approximately equal to that of contributions. After 23 years, interest has provided approximately double the wealth delivered by contributions. As the time frame stretches so that the effect multiplies with interest responsible for triple the amount at 30 years and 9 times by 45 years. So if you can invest for long, it's going to increase your money a lot. So this is because interest is earning on interest. So here is a graph that you can see that how it works is that this red is just your contributions earning interest. So it's increasing, definitely over 50 years it increases. But if your compound interest, so thinking back to lesson 9, compound interest earning on interest, after 10 years, it just grows exponentially so fast. At 20s, it's a little bit more. Look at 30, it's like 3 times the amount. At 40, and at 50, it's a gazillion times. Like, it's so much more money. Most of us don't have 50 years to invest, but you could. So that's just what's showing that the longer you can invest, the way more money you can make. So the second one is the effect of regular deposits. So the more deposits that you make, the more money that the bigger that you will earn. So here, in terms of your total interest earned, is this darker one, but the value of your investment, because you've been putting in those monthly payments, is much higher. There is, I will link, I don't know where it went, I thought I had it. Here, we can see. So there's a calculator that you can see. So if I have an initial investment of $100 and I don't put anything in, and I do it for monthly compounded for 30 years, we can calculate and we can see that after 30 years, we just put $100, the interest earned, we now have $245.68. So not very much, but it happened. Okay, so if we initially invest $100 and then we put in $50 every 2 weeks when we get paid, everything else we're going to leave the same. And now we calculate that just by putting in that $50 every 2 weeks. We now, instead of having $245 at the end, we have $63,375 because you keep putting that money in. So you're saving that money, but also you're earning, before we earned $100 in interest, and now we're earning $24,275 in interest. So you end up earning so much more, but also you're saving that money. So being able to deposit regularly is really going to make a huge difference. So if you can do it for long, and if you can regularly deposit, that's the best way to invest. All right, so quickly, just to consolidate before we run out of time, we talked about different types of investment options. We've talked about the different types of tax plans, tax-free or savings plans. We talked about risk tolerance and the type of investor that you might be. And then we talked about the investment tips in terms of time and regular payments really set you up for the most success. So hopefully you know the difference between bonds, stocks, shares, mutual funds, GICs, as well as RSPs, TFSAs, and RIFs, that you can explain what risk tolerance is, and that you can explain why time and regular payments increase your overall value. That's going to make a huge difference. So as always, if you have any questions, please reach out and connect with me. I am here. I know this isn't in your IEL booklet, so you don't have to answer questions on these ones, but this just gives you some information to help prepare you for life. And if investments are a good thing for you, hopefully you have some more information. Thanks so much for joining me. I hope you have a lovely day. Miigwech.